that we're talking about. Overall, decent set of numbers. Mayuresh Joshi from Angel Broking is now with us. Mayuresh, a view on HDFC Limited numbers. No dividend from HDFC Bank, because of which the PAT number is looking flat. That is generally about 18 to 20% of their profits. Do you think operationally numbers are good than what this PAT number is suggesting?
So clearly, yes, I think numbers stable and more or less in line with estimates. So whether you consider the NI growth, the credit growth, the margins, or even on the bottom line, because I think the street was factoring the deferment of dividend income to come through from HDFC Bank. And clearly, I think numbers, again, on the asset quality have met expectations. So I think stable set of numbers, not a great divergent factor on any of the counts.
Right. What would you look at once the management would start to speak? You think the outlook on margins, outlook on loan growth would be much more important than these numbers? They are broadly in line. There's not much of difference than what was expected for these numbers.
So clearly, Pankaj, as a thumb rule, housing finance companies, quarter one is supposed to be the weakest quarter. Quarter four is supposed to be the strongest one. So yes, I think the kind of loan growth that we've seen, the kind of provisioning that we've seen, and the asset quality that has panned out, I think you will see improvement, at least in terms of how the management commentary will pan out. So in my opinion, I think how they are perceiving credit growth to be, and the environment and the landscape of the current environment, I think that will be a key factor for HDFC's earnings going forward. But again, I think expecting a decent amount of credit growth to take place for HDFC, even from the management front.
Right. What was your view on the PNB, Union Bank, Bank of India numbers? Would you still stay away from the PSU names?
So clearly, I think Bank of India did disappoint on all counts, though marginally I think the NI number was higher than what we had estimated. But provisioning, asset quality and the profitability hit that it took, I think, much worse off than what we had expected. Similarly, for Union Bank, I think the asset quality has not held up. And clearly, I think consistency in earnings is something that we'll ideally like to watch out for. PNB showed some amount of respite when it came to the asset quality, both in terms of the gross and the net asset ratio were coming down sequentially, marginally, that too, on the net asset side. But clearly, I think the kind of exposure that these banks have on the infrastructure side, the SME steel sector, the sugar industry, I think one really needs to see consistency come through. So yes, I think at this point of time, unless I see stable numbers come through, at least for one or two more quarters, I think we'll not be having an aggressive buy position there. I think we're better off still with the private sector pace, where I think the earnings have also disappointed to a certain extent, but at least the capital adequacy and the asset quality issues are not so profound as they are on the public sector side.
Right, but how would you look at PNB numbers? There was not a great improvement. It's just that they did not see any further deterioration coming into a great extent. Is that something to cheer about?
No, clearly, and that's what I'm saying, Pankaj. I think the consistency has to happen through, and the management itself is of the opinion that it will take at least a quarter or two for some amount of respite to start taking place on the asset side. Clearly, I think within the PSU lot, I think it is well capitalized, the capital adequacy ratio is strong, and I think that probably holds it apart. But again, I think the kind of exposure that it has got to all the segments that we talked about, you're not really sure on how these constraints would pan out. So if there is a blip in a quarter, and again I think there is slippages in terms of fresh assets going into the bad asset book, and again I think upgrades and recoveries not happening as per the management expectations, you might have some amount of altering. So I think I'm looking at consistency in numbers. Just one quarter of stability is not enough. I think if that consistency does not come through, I think the street will not reward the stock even if valuations are on the higher side. So again I think PNB valuations, Union Bank valuations, Bank of India valuations are cheap, but again I think do they justify the kind of earnings growth that they're expected to deliver? I think I'll still wait for a quarter at least.
Capital raising, does that continue to be the biggest overhang for these names, and that will be the key trigger in FY16 if they can raise capital for further growth?
No, capital adequacy is required and capital raising is required, because I think if you look at their core CET1 ratios, I think they're still dismal, specifically in the mid-cap PSU lot. So a lot of banks need capital infusion to come through. And again, I think the capital infusion has to be directed in the way of expansion of balance sheet. Now, I think the asset quality pressures are so huge that the credit costs itself take a toll on their return ratios. So again, I think they need substantial infusion of capital to come through. It will be value accretive, but I think for the PSU lot, you need to give a larger time frame rather than the private side, where I think the issues are not so profound as I mentioned earlier.
Any sort of inference that we can make for some of the other names like SBI or Bank of Baroda, or you'll have to look at it by result basis?
No, again, result by result, and again, case by case, and even on the asset quality side, one really needs to have a look at a line by line check on the items. So clearly, I think SBI has given a stable set of numbers so far, and purely looking at its balance sheet, I think we're expecting stable set to come through. So again, I think one really needs to have a case by case look, at least on the PSU lot. But if I have given a choice, I think what would I choose within the PSU lot? I think State Bank is still something that we'll continue to prefer.
We've seen this quarter after quarter that names like PNB, Bank of India tend to disappoint. SBI has been volatile. They have disappointed and surprised on the positive side. You think that will continue, that does justify a little bit of more premium than some of these other banking names?
To a certain extent, yes. And again, I think the kind of exposure that even State Bank has, I think it is quite substantial to a lot of these sectors. But clearly, I think what stands out for SBI out of the PSU lot is again their capital adequacy is very, very strong. The CASA ratio is strong, and even on the retail franchise side, it's quite secured. So I think it's got a good liability franchise. Their branch network is quite strong, and that probably holds them apart. But clearly, I think the kind of industries that these banks have lent to, and the kind of working capital constraints that these industries are still facing, one is not really sure on how the asset quality will pan out, at least for the next couple of quarters. So I think I'll be extremely cautious when it comes to the PSU banking lot.
When you mentioned about SBI, you think, not only about capital adequacy, but even raising funds ahead, SBI would be comfortable versus some of the other smaller names?
It would, and again, I think it would be accretive immediately from an FY16, FY17 perspective if they are able to raise funds over the next few months or in the next quarter or so. And even the next 2 quarters, I think FY17 numbers will be far better for SBI because they've already got the branch network and the regulatory framework in place. So I think the operating leverage benefits will accrue to SBI much faster than the other banks.
Right. Dish TV, last quarter was a big bumper hit. This time around, they are decent numbers. They are not that good, not that bad. 3% decline. What's your view there?
So it's a mixed bag, and again I think it's a story which is playing out on the digitalization front. Many subscribers getting added on the digital front over the next few years. The analog viewers shifting either to cable or DTH. DTH guys having an upper hand when it comes to the cross billing cycle. And again I think clearly subscription revenue is something that one really looks at. Differentiated packages that Dish has come out with for metros and the other cities as well. So again I think ARPU growth is something that all the analysts look at probably from Dish's perspective, and clearly expectations are running high. But clearly it has been a mixed bag. So in my opinion, with the kind of run-up that we've seen on the stock over the past few weeks and months, a lot gets captured into in terms of either the subscription addition, how ARPUs will pan out over the next couple of years, how their capex to sales pattern will take place, and even generally the digitalization theme. So I think I'll be cautious on Dish TV at the current juncture. I think I'll further wait for how the management perceives the business environment to happen, what kind of competition it faces from cable, and how digitalization is coming up. And again I think a look at how their content and programming costs will pan out, which languish around 29-30% of their overall costs.
Would you be buyers into Dish TV at lower levels? At 114, how would you look at Dish TV? Would you be buyers at these levels, or you would wait and watch for a little bit more valuation comfort?
No, I'll wait for a substantial correction, Pankaj, to be more precise. It has run up too much, and I think the comfort level is not there because I think a lot of aspects related to growth, earnings possibilities, earnings prospects are probably into the price.
Right. The other big number that came out today, Mayuresh, was Maruti. Now, one would say that numbers are good. I mean, there's no doubt about it, but they were expected to be good. So they have met good set of expectations. Is that something to cheer about?
So clearly, I think robust set of numbers expected. Maruti did deliver. So 14% volume growth. If you adjust for the one-time impairment, the profitability is higher than what we had estimated at 1228 odd crores. But clearly, I think the street is aware of the numbers coming through, and again the realizations improved marginally. So clearly I think what hinges going forward is the kind of management commentary specifically on volume growth for Maruti. Anything in excess of 10% will be taken positively by the street, but again there are a lot of variables that one needs to work out for how the monsoons pan out, how there are different models in terms of new launches, specifically the X-Cross is perceived by the markets, and again I think the bookings have been quite decent even on the entry-level vehicles and the mid-level vehicles for Maruti. The yen depreciation did help the EBITDA margins this time round, so again the management commentary on whether margins will be sustainable will be key. So in terms of earnings, I think at around 220 rupees FY17 EPS, our take is that it is reasonably valued at the current juncture. So I think investors who are holding on to the stock at lower levels continue to hold on, but I think at buying Maruti at the current levels, I think I'll still wait for declines because I think it is close to fair valuations in our opinion.
So basically, because of the valuation, the beat had to be very big for the name to move up. That's what you're trying to say?
I think the beat cannot be more than what the markets probably perceive, because I think you do get a month sales number coming through, and for Maruti to probably keep on beating estimates in terms of either a quarter-on-quarter and a year-on-year growth would depend on 2-3 main factors. A, how the rural demand and the semi-urban demand catches up. B, again I think the kind of acceptability of the new products or the new cars that come through, and C, I think if the business environment improves and if the credit cycle improves in the economy, I think the discounts per vehicles and the realizations per vehicle correspondingly will show an improving trend. So in that sense itself, I think one really needs to understand from the management if they're able to do that and whether margins will be sustainable at the levels that we are witnessing right now, which in all probability looks like expansion from the current levels very, very improbable in the next 2 quarters. So again, I think a lot has been factored in terms of the earnings outlook for Maruti, specifically from an FY16 perspective.
Mayuresh, just stay on with us. We're taking a quick break. Coming back in 2 minutes, we'll discuss about other earnings as well as what's your outlook on the market on the other side. Nifty is down about 8 odd points, absolutely flat today. Earnings are coming in thick and fast. Mayuresh Joshi from Angel Broking is with us. Mayuresh, markets are down 8 odd points, 8,350 levels. Okay, I think we have some technical issue with his line. We'll just go back to him. But markets are down 46 points. Sensex on your screen. Mid-cap index was doing well off late, but slightly starting to see profit booking. We cannot say that it's seeing selling pressure. It's just off the day's high. Mid-cap index up 0.8, small-cap index 0.1. Advanced decline looking decent. 44 for advances versus 51 for advances. Nothing much to take over, but yeah, declines are slightly more. NMDC has been weak since morning actually today, 5% on the lower side. Hero MotoCorp was down 5% yesterday, down 2.5% today, so it's down about 8% in the last 2 days. HDFC Limited, you just heard the results, 2% decline. Dr. Reddy's down 2%. In India down 1.6%, 165. Tata Motors continues to be on the losing side. ICICI Bank down 1.6%. Results are yet to be declared. Some of the other private banking majors have already declared results. HCL Tech down 1.1%. Asian Paints down 1%. Wipro down a full 1%. 556 for Wipro. HCL Tech down 1.1%. Gainers are from the results pack. PNB up 4.7%. BHEL up 2%. NTPC up about 2%. Mayuresh Joshi is now back with us. Mayuresh, at 8,350 levels after a good 300-400 point correction that we have seen on Nifty, would you say Indian markets are buy, or somebody who is looking to invest should use this correction to buy some good quality names?
So clearly yes, and again I think the range that we are working out stays the same. So I think 8,000 to 8,500, 8,600 is the range that we expect the markets to be in. And any correction from the current levels, if it happens to the lower end of the range, I think any qualitative stocks, whether that be large cap or mid cap, if they are available, I think should be accumulated by long-term investors. But the horizon has to be more than 12 months.
But what is your view? Are we fairly valued right now? Would it take some time before we see major outperformance from the Indian markets?
So for a re-rating structurally to happen, Pankaj, I think corporate earnings need to show significant improvement. We are not seeing that happen, at least for the next quarter. And again, I think if there is no capex cycle which gets revived or government spending not coming in thick and fast, I think the earnings recovery will get delayed by one more quarter. So again, I think we'll push through earnings recovery from the second half to the first half of FY17, which will not be taken lightly by the market. So in my opinion, I think a structural re-rating for the markets depends on corporate earnings, and corporate earnings still a couple of quarters away for revival to happen. So in that sense itself, I think you're seeing a consolidation phase still panning out for a longer time. And again, I think all the factors, whether they be international or domestic, will keep on playing truant at some point of time over the next few months. So I think a stock-specific approach, in my opinion, is more warranted at this point of time than looking at Nifty levels, which again, in my opinion, over longer-term averages are currently trading at fair valuations.
What's your view on the flows? Domestics have been supporting the market. Do you think that support would continue?
So clearly, I think a lot more hinges on what happens in terms of the domestic situations. I think how the key bills are expected to get passed. If not in this session, I think the markets again are factoring in a lot more happening through the next session of Parliament. But again, clearly, I think earnings recovery is something that the markets will look for, and if that is delayed, I think the markets will correct even from the current levels.
How would you look at the FII flows? It's been volatile. Do you think that now that they are so overweight on India, it would take some time before we see big money coming in?
So clearly, I think from an FII perspective, in the entire emerging market basket, I think India still stands out. China is already witnessing problems of its own. Russia, Brazil, more commodity driven, and more of the Southeast Asian economies, including Indonesia, Thailand, fairly valued as far as their long-term averages. So I think India stands out with the emerging economies. The currency has held out, and again, I think our forex reserves speak for itself when it comes to the currency background. So clearly, I think India stands out. Substantial reform implementation and the capex program by the government will get more flows, in my opinion, but they need to see these things happening before they pump in more money.
Right, but overall your view, flows would tend to increase. A lot of ownership to institutions would tend to increase over a period of time. I mean, that does make it a buy on every time markets are declining 5-10% in India.
So clearly, as the situation holds, Pankaj, I think India still remains a structurally positive story from a long-term perspective. And again, in terms of how the corporate earnings will pan out because of lower commodity prices in the second half of this year, and if they stay benign, I think the corporate earnings will see some revival happening. If it is abetted by capex spending from the government side and private capex follows a quarter or a couple of quarters after that, I think FY17 earnings will be in a far better shape than what we are perceiving right now. So in our opinion, I think the structural side of story remains the same. It all depends on these key variables and how they pan out over the next few months or quarters.
Right. Bank Nifty view on the entire banking space. Now that we spoke about the numbers in quite a bit detail, you think private banks would tend to do better than public sector banks? We've got now a whole host of number, and you would have now got a fair idea of how these two different sectors are doing it.
So again, as a backdrop, I think the credit growth is still expected to be sluggish for the better part of FY16 if I take the entire banking industry as a holistic picture. The asset quality, again, I think it's going to be worse off for the PSU lot. We've already seen a mixed set of numbers coming through when it comes to both the gross assets and the net asset ratio for a lot of these PSU banks which have come so far. And again, I think it's not been an encouraging trend in terms of how credit growth has panned out even on the private side. So in my opinion, I think if I need to take a call, I think private is still something that I'll stay with in these markets. But clearly, I think a lot more hinges on how the credit cycle pans out, how the asset quality pans out, and I think the private guys hold an edge over their public sector counterparts in these aspects.
Right. Tata Motors, what will be your view? The fall that we've seen, is that a buying opportunity?
Oh yes, I think it becomes a good opportunity to start accumulating the stock. China has been a concern, and the way the Chinese markets are reacting, I think you will still see some amount of sluggishness in terms of volume growth, specifically from the Chinese markets, at least for a quarter or two. But again, I think the domestic volumes have held up. They've started picking up steam. There have been few launches on the PV side. And again, I think apart from China, I think JLR has held up pretty well. So in my opinion, I think valuations have become attractive for Tata Motors. And I think, yes, it's a time to accumulate slowly and steadily Tata Motors at the current.
Do you think that markets are just factoring in a lot of negative news coming in from China, or a lot of degrowth to happen in China, which may not be the case?
So clearly, I'm no China expert, Pankaj, but whatever data is pointing out, I think it's not pointing out in the right direction, and clearly, I think that is getting reflected in how your commodity prices are moving, because I think the demand-supply dynamics are definitely not in favor of the commodity cycle. Having said that, I think one really needs to understand how the data points will move specifically in relation to the Chinese economy. And if Chinese economy slows down, I think you're going to see a gradual slowdown even in the world economy, because India is not going to just stand alone there and say we are going to grow our exports. If China is falling, I think you're going to see subdued global demand taking place as well, because Chinese economy is more or less a reprocessing economy, and if there is slowdown there are global GDP growth concerns as well.
You are always a bull of names like Lupin and Sun Pharma. Now they have seen a big correction. Do you still have your faith? You would want to wait and watch if anybody wants to get into names like Lupin or Sun Pharma?
So clearly Lupin disappointed Pankaj on all counts, and the acquisition again, as we discussed the last time round, I think seems very expensive at this point of time. How the synergies will pay out from an FY18 perspective is too difficult to say at this point of time. Sun again clearly having integration issues. The profit warnings which have come through would ensure that the better part of FY16 would see margin compression, and again the ROE is compressed. But again, I think in my opinion, Sun Pharma is a qualitative franchise. FY17 onwards, once things normalize over the next few quarters related to the integration issues, I think the earnings growth shall revive, and I think the recovery will be much faster than what the street expects. So in my opinion, I think valuations plus earnings recovery post FY17 makes Sun a very lucrative bet at the current juncture.
Mayuresh, thank you so much for joining us here this afternoon. Hope you have a great day going ahead. We are taking a quick break, coming back in 2 minutes. On the other side of this break, we'll be talking to Union Bank. They declared their numbers earlier.